become such a hot topic today among people getting ready to retire. Everyone thought they had a pretty good handle on it, but there's a lot of confusion out there. So I think that could be of interest.
Yeah.
Speaking of the weather, how is it in Chicago today?
Oh, it's in the 40s here, but tomorrow we're hitting the 50s, 60s on St. Patrick's Day here. So nice day for everybody walking around with the Chicago River dyed green.
Well, we're excited here, too. It's kind of a dreary day here in the 40s, but we're going to hit 70 degrees St. Patrick's Day.
Oh, man.
It's going to be a nice day. Yeah, I think everyone's ready for a little warm weather.
Definitely. Definitely.
Nick, I see it's 229, but I see the numbers just flashing like crazy on here. Why don't we, for the benefit of, if the people on now, looks like we have about 125, if you guys and girls wouldn't mind just waiting a couple more minutes, let's wait for some of these others as they're launching and maybe get on here in about 2 minutes.
All right.
Our record here, and if this is the case, I'm always going to have you be the lead act, and I'm just going to take color.
Hey, it could be a good format here. We'll see. Yeah, it's too bad that they did hire Ron Santo's replacement. Keith Moreland, you remember him?
Yes.
Yeah, he's a new color guy. He's a
well, I don't know if you saw this in the Chicago papers, but it was in the Indianapolis Star today as well as in the USA Today. One of our great color guys here who was a Pacers coach and led him to 4 ABA titles, and he played in the league.
Oh, yeah.
Bobby Slick Leonard, when he was doing the game the other night in New York when we played the Knicks, he fell over with a heart attack.
Yeah, I saw that.
In the hospital, and I haven't heard this afternoon, but hopefully he's going to be okay. He's 78 years old, and Bobby Slick Leonard is so much a part of the Pacers, and anyone that's ever watched a Pacer game, in particular when Reggie Miller was shooting, he developed the phrase every time Reggie would make a basket, boom, baby.
Yeah.
So that's him.
I hope he's going to be okay.
I could start talking sports here, but even though we have more coming on, it's 2:32, and these people have been so gracious to give us some of their time today. Let's go ahead and get this kicked off. Sound okay to you?
Sounds great.
Okay. This is going to be probably a blessing. I'm losing my voice today, but we wanted to set this up and have Nick Ohlson, one of my sons, do this capital transfer presentation. As most of you know, Nick runs our Chicago office. We're here in Indianapolis. I'm very fortunate, very blessed to have two very good, smart sons working with me, Nick in Chicago and Joe here. And I'm very proud that after Nick left Zurich after Chicago and started working with us, he quickly got his Chartered Financial Consultants designation. And people that are working with us presently know that if they need a capital transfer package put together in an analysis where they might in the past used to come to me or some other people, they go to Nick. I just wanted to really open up to give a little landscape here. This is the greatest opportunity to hit our industry for a long time. Capital transfer, the usage of life insurance, single premium life that Nick's going to go through. But these are dollars that are geared to be passed down to other people. It appears that only the last couple of years really has been the big thrust in capital transfer. Bragging a little bit with one of the companies we work with in 2009, we were their leading single premium life operation. I think we were in 2010. And a new company we're taking out. I'm pretty confident that in 2010, their launch year, we were up at the top. We may do more single premium life, especially on the simplified issue basis, than any other IMO in the marketplace. And maybe that's because coming up as a life guy, through a career system, having a career shop, we were geared to life insurance and all the magic. So going through this, I'm going to interject a few tips from time to time, but this is one of the most lucrative opportunities. And so have that piece of paper handy, and I would suggest as Nick is talking, write down the names of people that you can think of, friends, clients, prospects, because they're out there and they're waiting for your call. So I give you today's star of the show, Nick Ohlson. Take it, Nick.
Well, thanks, Dad. Thanks. Well, hey, yeah, we're going to go through a few different things today here, everything from sales ideas, real case design type of things. And, of course, we're also going to talk about products that fit into these places. And, of course, what types of products actually do fit in here. But first, what I want to talk about is, what is capital transfer? What are we talking about here? Well, what are the reasons behind this? The first thing we're trying to do is to leave a larger net estate after taxes for the next generation, or maybe a spouse. We're trying to find, the less total income tax owed when you pass money down, and put, the heirs into a smaller tax bracket if possible. All these things together we call, avoiding the annuity or IRA tax time bomb.
Okay, one interruption, Nick. I got to tell everybody, write down on your piece of paper in case we forget to talk about it later. If you haven't seen it, ask us, call in afterwards and ask us to send you the 10-minute tax time bomb video. Sorry, Nick, go ahead.
And yeah, basically what we're referring to that is, you have an IRA or a tax-deferred annuity with a big buildup. When it hits your heirs, not only do the taxes really need to be deducted and paid out of that before the money's passed on, but it will also increase the tax bracket that your heirs are in, on their own wages that they brought in that year. So not only are you cutting down on the amount of inheritance you're leaving, but you're also taxing your children or next generation at a higher rate due to that total extraordinary income that's coming in there. So although they may be thankful you're passing down money, it's always nice to do it on a less tax burdensome basis. One of the other things we're going to talk about is how to recover market losses by using these products, and also to provide emergency long-term care type of dollars here that aren't considered a use-it-or-lose-it type of situation. Now, what are we talking about with capital transfer here? Well, the main product we're talking about, of course, is life insurance. There are unique features of life insurance that aren't in other type of products. We have the immediate increase in estate value day one. When that first premium's paid, you have a death benefit that is well in excess of the amount of money that you put in there. There's really no other product on the market that can do that. We have tax-deferred growth on the cash value, just like an annuity. So you get tax-deferred growth. And then, of course, the one unique thing is an income tax-free death benefit that you can't get with an annuity or a qualified account. And then, of course, we're going to talk about single premium type of products, where it's an annuity or CD or maybe even an investment alternative, or a multi-continuous pay premium when the client's putting money in, monthly, yearly, quarterly, or maybe even just for a limited, 5, 7, or 10 pay type of period. First, we're going to start with talking about single premium life insurance. Now, all the products that we talk about here today have a no-lapse guarantee, which means you put a certain lump sum of money in, that death benefit is either guaranteed to age 100 or 120 or 105, depending upon the product in there. But you'll never be asked for another dollar of premium like the old-time ULs that would blow up because assumed interest rates weren't performing like they expected. So you never have to worry about another dollar. Most of these products now have living benefits here, meaning that if the client is diagnosed with a terminal illness, you can get at the death benefit, and even more importantly, or at least as important, that they can get at money if they have a chronic illness, which we're referring to normally as some type of long-term care event, which is normally diagnosed if you can't perform 2 activities of daily living. So we'll tell you how those work. We have simplified underwriting or full underwriting. We're going to talk a lot about simplified underwriting today. And yeah, these are all modified endowment contracts. And not to be elementary, but a lot of people think modified endowment contract is a bad word. Well, the only difference in a modified endowment contract versus a life product that meets that 7-pay test is that if you borrow money out, it's not going to come out tax-free on a modified endowment contract. it will be taxed like an annuity. But the death benefit is still income tax-free on a MEC. The products we're going to talk about today, and we have a wealth of different products, so be sure to call us if there's something else you're looking for. But the main products are with Sagicor and Equitrust. Sagicor has a fixed and an indexed version of their single premium life, as does Equitrust. And then we're also going to talk about Sagicor has a 7-pay whole life SPIA combo, where you can put money in over 7 years. If the client doesn't want to put it all in 1 year, which is usually due to some type of tax situation, if they're paying it from an IRA or maybe a deferred annuity that has a big taxable buildup. They don't want to take that tax hit in 1 year. We're going to show you how you can take a SPIA to fund this life product over the 7 years, spread out the taxes, get a paid-up policy, and hey, we're going to get 2 commissions on this as well, which most people don't complain about. These are all the simplified underwriting products, so there are no exams required. Most of the time it's just a telephone interview and the application. So let's start in on the Sagicor products here. Sagicor is an A- rated carrier based here. Their main offices are out of Tampa, Florida. You know, they're fairly new to the game, I guess, in the grand scheme of things in the United States, but they've been around for a long, long time here, and you know, on a global basis, they're traded on the London Stock Exchange and do business in 20-some countries. The big thing with this product, they have a couple main features. One is this guaranteed return of premium at any time, meaning that if the client puts in $100,000, let's say, no matter what the surrender charges might be, they can always get back out that $100,000, no questions asked. It also has a 10% bonus to the cash value, just like those annuities you're used to selling. So that can help get over any taxes or surrender charges that the client may owe. This has a great chronic illness rider, which will accelerate all but $25,000 of the death benefit to the client over 33 months on a tax-free basis. And this is if they can't perform 2 activities of daily living. So we're going to show you later how this can be used as a non-use-it-or-lose-it long-term care style of policy. Of course, we're not saying this is going to be as encompassing as a long-term care policy would be. But a lot of clients don't want to pay those annual premiums. They don't want to buy what they perceive as maybe a use-it-or-lose-it type situation. So this is a heck of a lot better than self-insuring. This product standard issued through Table 4, meaning they can be preferred, standard, Table 1, Table 2, Table 3, Table 4, all the way down through those levels and still get the either smoker or non-smoker rating. It has a 7% commission on the single premium here, and it will issue through age 85. There are 3 interest crediting options. Like I said, it's called the fixed indexed single premium whole life. And we've got an annual point-to-point with an 8% cap. That's credited annually every year with an annual reset. And they have a global basket strategy where they take the 2 top performers out of the Hang Seng Index, the Russell 2000, and the Dow Jones Euro Stock Index. And the first place one gets a 60% weighting. The second place one gets a 40% weighting. And then the third one's thrown out. Then they give that a 45% participation rate, and that's credited over 3 years. So that may sound kind of complex, me just quickly explaining it here. If you want to see some examples, we'd be happy to get some of those over to you. But it's a great way to get some global exposure with some of these index crediting strategies if your client doesn't want to just be in all of the S&P.
Hey, Nick, and I could give you one other bit of information I just got last evening from Sagicor. The global basket strategy, where it's been credited on a 3-year basis, starting April 1st, it'll be much easier to explain, it will be a 1-year product. So
Great.
it'll just be credited over the 1 year.
Okay, well, that's just a couple weeks away on April 1st.
Okay, so we are right there. And also Sagicor, I was just trying to look here. It's 140, 135, or 140 years old.
Okay. Yeah, I think it was the 1850s or something like that from
Like that,
what I
just
remember.
about
Somewhere
when I
back
was
then.
in preschool.
Yeah. Well, they also have, too, of course, if you don't want the index strategies right now with the markets being a little rocky, I've been kind of looking all day today. I've been scared to see what that Dow has been doing. I know we're down about 180 when I last looked. But you can have a nice 4% interest rate in there, too. You just want to stay fixed. All right. Well, they also have a companion product called the interest-sensitive single premium whole life. It's got all the same features as the index version, except they don't have the bonus to the cash value, but they do have a higher commission at 10%. Also, this one's very unique, and we get a lot of play with this with the older clients because it issues through age 90. So, and we have had a lot of policies that are issued on 88, 89-year-olds, and people are being healthier and living longer, and as long as they're payable for a 90-year-old, you can get this issue. It's got a 5% first-year interest rate, 3.5 base, and it will go no lower than a 3% rate on that. The third product from Sagicor, like I was saying earlier, they have one that's spread out over 7 years called the 7-Pay Indexed Whole Life. Still has the same guarantees as far as the no-lapse guarantee on the death benefit, and still has these riders for long-term care, but it's paid up after 7 years, 7 equal payments over the 7 years, and we can use it as a combination sale with a 7-year certain immediate annuity that can be paid directly in to that contract to spread out a tax burden over that 7 years. Now, this one's paid more like a traditional life policy with a 90% commission on target in year 1, but also they pay 4% on the excess commission in year 1 and 4% on renewal. So you can get paid a nice trail commission over 7 years on this.
And Nick, if I can add something to that too, the renewals are great, and the 4% of the excess is tremendous. And, the target, it's one thing to say whether they're paying 90%, 70%, or 190%. A lot depends on the target. It's a very strong target, so you're making 90% of a good amount of money. And unlike some of the competitive products that are out there that we carry as well, with some other companies that Nick isn't going to go over today, if your client were to die, and Nick's probably going to hit on this later, first of all, you're making commission on the SPIA as well as on the 7-Pay, and if your client was to die during that 7-year period, they would not just get the death benefit, they will get the balance of the SPIA payments. And you may be hitting on that later, Nick, but that's such an important differentiation between this and other products.
Definitely,
so,
definitely is. All right. Well, the second product line here that's similar to the Sagicor one, looking on the simplified underwriting side, is from Equitrust. I know many of you probably out there have done a good business with Equitrust on the annuity side, but they opened up this life side, about a year or so ago, I guess, and there are 7 total IMOs that they picked to represent their single premium life contracts here, and fortunately they chose us to be one of them here. And they have 2 different products similar to Sagicor. The first one's called the interest-sensitive single premium whole life product. Actually, that's what it is, but it's called the Wealth Sure Life. This is their fixed product with a 4.9% first-year interest rate, 3% guarantee, issues through age 85, is standard through Table 4 as well, but has a whopping 15% commission through age 80. And even 81 to 85, 11.5% commission. So this is a very nice payday on this product, still with a phone interview and application only as the underwriting.
That's exactly right. The underwriting with Equitrust, as well as with Sagicor too. But this product, we have some other products that pay 15% commission that are non-participating whole life, where you're going to see your guaranteed cash value in the policy. Or those policies, you can just tell your client, stick it in the sock drawer and be done with it. Well, you could do the same thing here, but what they're going to do is they declare every year and pay excess interest. Excess interest whole life, interest-sensitive whole life is an old policy. And the way it's set up, it does allow your client the opportunity of getting more than just the guaranteed cash value, but it's great for your client that doesn't even want to talk about an index, the S&P, crediting rates. Doesn't want to talk about that at all. They just want to see interest rates and guarantees, and they don't want to see a statement every year that says this is the worst scenario, the best scenario, or in between. So the interview, you do the interview while you're there. You pick up the phone, you call the underwriters, they ask your client the question. You could be approved at that point, but it's going to be very, very quickly when the client is approved or not. A fine company. As a matter of fact, it's a subsidiary of one of the largest companies in America, Farm Bureau Life, Iowa. Thanks.
All right. And they also have some very competitive long-term care alternative type of riders here, some accelerated death benefit riders. One of them is if the client goes into a nursing home, they will accelerate 100% of the face amount over 3 years. Or they give you the option of a lump sum of 85% of that face. For terminal illness, they'll accelerate that whole death benefit to the client. And for chronic care, for the chronic illness type of deal, it's another deal where if you can't perform 2 activities of the daily living, then they'll accelerate all of that death benefit over 5 years. Or they give you the option of 75% for the lump sum.
Nick, if I could add something here too that really came to mind today when I was at our continual education class, the Society of Financial Service Professionals, we have a 5-hour refresher course coming up here for people to continue to be long-term care insurance certified. One nice thing about chronic illness benefits, accelerated benefit riders, whether they're nursing home riders, chronic care, you do not, to the best of my knowledge in any state yet, but things change very rapidly, you do not need additional specific continual education credits to sell this. The other nice thing, too, that we get with this product and with the interest sensitive, with Sagicor as well, and again, things change very quickly, but I like to call them very BD friendly, broker-dealer friendly, where it is usually counted as outside, because for sure it's not an equity product, it's a variable product, it's not even an index life product. This is an interest-sensitive whole life product.
Exactly.
Okay, thank you.
Now the other companion product that they have here, Equitrust, is called the Wealth Max Bonus. This is the second one that they came out with. It is their indexed version of the product that has a 12% first-year cash bonus right up front to help, once again, get over any surrender charges from any product you're moving it from. And, of course, if there were any taxes owed from getting out of any other vehicle, it's nice. You get it back in the cash value of this contract. It has a return of premium guarantee, a true money-back guarantee as well, like the Sagicor products we discussed. It will issue through age 85. Now, one of the things that I've noticed with a lot of our agents that really kind of go crazy about are some of the crediting strategies on this product. First of all, yeah, that's not a typo. They have a 4% monthly point-to-point cap with 100% participation on an annual reset basis. Now, really on the annuity side, you're lucky if you get 2.5 these days on a very good monthly cap. With here, you're getting all the way up to 4% per month. Also, they have an 8.5% annual point-to-point cap, which is also very tough to find out in the annuity market today. They have a no-capped 2-year monthly averaging strategy with 100% participation, meaning it's just credited every 2 years to your client's account, but there's no spread, no cap, just a monthly averaging strategy credited over 2 years. Also, they've got that 4.2 fixed which can get a nice return to your client in the first year if you combine it with that 12% bonus. And this one as well has the same underwriting as the fixed Wealth Sure product, standard for Table 4, and the same chronic care and nursing home riders to make it kind of a long-term care hybrid contract. And once again, like my dad said, without needing to have those CE credits because it's not officially long-term care insurance. This one has a 9% commission through age 75 and reduces at the older ages. I know my dad's going to get all excited here, so I'm just going to go ahead and click to the next slide because I know he's going to want to talk about this here with kind of the package that Equitrust has to get on board.
Yeah, I mean, I still got to take this first one. I hope if any of the home office people from Equitrust are on this webinar today, please put your fingers in your ears. Why? These people are nuts. A $2,000 first app bonus. A $50,000 app, $50,000 premium. On top of these commission numbers, you get a $2,000 first app bonus. You talk about a welcome aboard. Folks, I guarantee you, we'll talk after this. I will find someone in your book of business where, if nothing else, you're going to get a $50,000 sale, get a hefty commission, and get a $2,000 app bonus. And then, it's very fitting that St. Patrick's Day is around the corner. You talk about the luck of the Irish. They have a trip, $500,000 of premium. You have to have it submitted by 12/31, paid by 1/31, if I understand this correctly. Yes. And in June, you're going to Ireland for 5 days. And then you do $1 million and $2 million, you get more days, you get more stuff. This is one great launch. And it's their commitment to this market, and they want to really bring attention to these 5 products they have. But come on, let's get the $2,000 app bonus.
Well, yeah, and just to have a little urgency too, that money, that application must be received by the end of the month to get that $2,000 application bonus.
Oh, so we'll
get those in here quickly in order to benefit from that. And from those of you who have put cases in already with Equitrust, they've got, this contest started from February 1st. So any business you have, you're already on your way to that low level of $500,000. And this is really, I was out at their meeting the other day. This whole trip is really the equivalent of a $2.5, $3 million annuity premium type of reward trip. And this is going to be a one-time only thing with them, I'm sure, getting on board with the early group on the life side. So take advantage.
Okay, 3:31. I'm going to bed early because everybody's going to have to call us this afternoon or tomorrow to get the $2,000 bonus.
Okay. All right. Well, next thing we're going to talk about here are the fully underwritten products that we have here. These are more flexible in the sense that you can do them as a single pay, a limited pay, or a lifetime type of payment. You get a bigger bang for your buck with these products, meaning that if a client is healthy and we can get a preferred rating, they're going to get a higher death benefit. They have no lapse guarantees, meaning you can figure it out that as long as you make a certain premium payment, the client will never owe another dollar, and that death benefit will be guaranteed all the way to age 121. And we can make a lot of these non-MEC products, and if you want to take money out later on in the form of loans, it will be tax-free. We have many carriers to choose from, and we'll go through a couple on the illustrations that I'm going to go over here in a second. Dad, are you getting an echo on my voice here?
No, I'm not.
Okay, it's just me, I guess. All right, well, let's get down to some case studies, some actual cases from some of our producers that have utilized these products and these ideas. The main areas we're going to talk about, first of all, the simplest one, talking about moving annuities or CDs into life insurance. If the client decides through some of, the fact-finding you do that, hey, I'm not going to live on this money, this isn't going to be the income I need, I'm just going to pass this down to my wife or my kids or some type of institution, then why not tax-free with life insurance? Also, variable annuity rescues. When somebody's stuck in a variable annuity that's lost money, but maybe it has a death benefit to it that they're holding on to. Well, if it's the reason that they're holding it is for the death benefit, much better way to do it with life insurance. The other product line here, or the other way we can do it is through loss recovery. Showing if a client has lost money in the market, then we can get it back through that life insurance death benefit. We also can show how you can get out of a fixed or a fixed index annuity product for the death benefit and get out of some of these, two-tier type of annuities or something where they're stuck with low caps and maybe high surrender charges, and you need to find a way to get them out and get back above water. Also, which I think is my dad's favorite part to talk about, we're going to talk about the 5% solution by taking a 5% withdrawal out of different funds in order to fund a life product. And in the same token, we're going to talk about replacing the lost Social Security income from after one of the spouses passed away. Then also,
you are
we're going
echoing
to
a little
use
bit now.
As a long-term care alternative. Okay.
Yeah, that sounds a little better, Nick. You were echoing here. Some of the other people in the office said I couldn't hear you.
Okay. All right. The next case study we're going to talk about here, or the first one is the annuity to life situation. We've got a male age 70 with $150,000 in an annuity, currently earning about 4%. There's a $100,000 cost basis, meaning that there's a $50,000 buildup in the annuity, taxable buildup. We also have a 5% surrender charge in there too. So we find out through the fact-finding process that we want to leave money to the kids. Am I sounding better here now?
Yes.
Okay, it's echoing like crazy here for me, so I apologize if I'm talking crazy. Anyway, so what I would recommend is to surrender the annuity, pay income taxes, and pay the surrender charges, of course, and buy the Encore next single premium life product. Well, after paying the surrender charge and then paying deducting 25% for taxes off of that gain, we're going to have $131,000 left over to buy Encore single premium product. That will give the client a guaranteed death benefit of $212,000 all the way through age 120. Now, if you look at the gain in the contract, or excuse me, the potential gain, crediting strategies, we can get all the way up to $364,000 by life expectancy time. Now, that's not guaranteed, but that $212,000 is the guarantee. So we have a software package that kind of gives a snapshot on how this works, where, say in the current annuity at $150,000, growing at that 4% rate, at life expectancy we get to a $249,000 death benefit. But you have that tax time bomb where they're going to owe $37,000 in taxes. So we're really only going to be left with $212,000 after tax, which just happens to be the guaranteed benefit you get day one when you move over into the statutory single premium life product. And then, of course, you can do a lot better. Current conditions, if we compare apples to apples with game, getting up to $364,000. Now, they also do a nice job of showing here at the bottom that for the current conditions, you're going to you're going to have $151,000 more, or $72,000 or 72% more if you transfer it to life insurance.
Nick, what I'm going to do here right now, yours is coming in a huge echoing here.
That's what I'm saying, yeah.
Yeah, and how about let me just kind of take it from here for a second, if you don't mind, and I'll bring you back in and we'll see what's going on with your phone.
Please do.
Okay, let's take a look at this case study, Annuity to Life. Well, here's what we have. We have a 63-year-old male that has a $120,000 annuity. The cost basis is $40,000, so consequently we have an $80,000 taxable gain. Well, what we want to do is we want to move it to an income tax-free death benefit. And he does not want to recognize $80,000 of taxable income all in 1 year. And if, Nick, you can flip the page for me, because I think you've got control of the deal there. We have a solution. What we're going to do is we're going to do a 1035 exchange with the current annuity to the Sagicor 7-pay single premium immediate annuity. So we're going to get the regular tax-free exchange. This is also very nice to keep everyone else at bay because this moves very quickly annuity to annuity. We're going to assign the SPIA payments as premiums to Sagicor indexed 7-pay whole life. So the money will go into the pot, into the SPIA, and every year for 7 years the premium will come out, thereby spreading the taxes over 7 years, and the policy is all paid up after those 7 years. Well, what we'll do is let's take a look. In this solution, the SPIA is going to pay $18,824, that's the annual premium, to the life policy for 7 years. $13,000 and some change is taxable every year. The death benefit is $200,000 plus, and that's vested day one. And as Nick has on the chart here, if the client dies during the 7-year payout, then beneficiaries receive the life benefit and the remaining annuity payments. We also have a situation here, as Nick was talking earlier about the chronic illness benefits, the inability to do 2 of the activities of daily living. This would provide $5,323 a month. That's available for the long-term care. And remember, the person does not have to be institutionalized. The person does not have to recertify every year, every 2 years or whatever. Once this starts, it's gone. The train's left the station. Let's take a look at another case study. CD, Certificate of Deposit to Life. We have a female age 74. She has a $50,000 CD that's paying a 2.5% rate, which you know is a very strong rate today. As an aside, your cheapest little sales tool that you could ever get is the Friday USA Today. For 75 cents, if nothing else, just take the money section. And always on the lower left column by bankrate.com, they list the CD rates last year. They also list what it was last week and what the average 5-year CD in America is today. And it is about 178. So a very realistic number. So Grandma wants to leave the CD to the grandkids. So here's what we're going to do. We're going to surrender the CD. There are no taxes owed on the CD because on that CD you pay as you go. And we're going to buy the Equitrust Wealth Sure Life. So we've got the surrender value, which is $50,000, and again, no taxes were owed. And remember, the surrender value is the same as the penalty for early withdrawal. Most safe money places have some type of a surrender charge or a penalty for early withdrawal, and the CD is no exception. So we put that money into the $50,000. All of a sudden, we have a guaranteed face amount, a guaranteed death benefit of $74,000. Well, here's another case study on a loss recovery. We have a situation, the male is age 70. He had a $100,000 brokerage account to leave to his heirs. Market losses decreased value by 25%, and client wants to recover those losses for the heirs in a tax-efficient manner. Well, I think we may have a lot of this going on. You know, I was very proud in meeting with the guy that handles our 401k, and they're a good fee-based firm here. And even though I have a Series 7, you know, they're handling my money. And I was very proud that I had made up all my losses during the Great Recession. Well, I've given a lot of that back. We had the Nikkei was down 13% when I went to this meeting this morning. As Nick said, we're down big time again. We're going to have a lot of volatility in the marketplace. So there's a lot of people that need to recover those losses because they were counting on those dollars to live off of a retirement and to leave to their surviving spouse if they had one. So the only way without risk to truly lever up and take care of that is to do what we're doing here. We're taking that $100,000, as we said, the market had decreased the value to $75,000, and we're going to purchase a fixed index single premium whole life. Well, the $75,000 plus the 10% cash bonus equals a $120,763 guaranteed death benefit. And in the event of death, that income is tax-free. You know, when I say in the event of death, there's a great man that's written a couple great books, and sort of my idol, I'll just go ahead and say that, is a young guy in the business, the late, great Benjamin Woody Woodson. And he was the chairman and CEO of American General, and he always wrote the back page in the National Underwriter, or Life Association News. And someone in this, I think it was in this MDRT magazine that I got at home, Round the Table, they reprinted an article by Woody. And part of it, I'm paraphrasing, says, you know, people buy life insurance in their 30s just in case they might die. People in their 60s and 70s buy life insurance because they know they will die. And this is the way to make things whole. So let's look at another situation. A person has the money in a variable annuity, and they lost money. And again, remember, if you don't have a securities license, you're not supposed to give investment advice on equity products, variable annuities. And I'm not making any prediction that the market's up or down. This is for agents only and not for the consumer. There's my little statement there. So we have a 74-year-old male that lost money in the variable annuity market, holding for the death benefit. He's holding on. The original premium was $150. The cash value is now $111, and he has a death benefit of $160. And that 74-year-old is saying, I can't get out. I got to hold on because mama's got to have that $160. So what we're going to do is we're going to surrender that variable annuity, and we're going to buy Aviva's Advantage Builder 2. This $111,000 single premium will give us a death benefit, a face amount of $232,645. And that's going to be income tax-free and is guaranteed to $120. Well, again, my math is not always the greatest, but a $232,000 death benefit is much better than a $160,000 death benefit. It would take longer than this person has at a CD rate to have that 160 ever reach 232.
And of course,
well,
was
here's
one of
another one.
Situations where, yeah, you went through the fact-finding process and found out that that is what they wanted to do, was to leave for the death benefit. Hey, if that's the deal, we could do much better than the variable annuity.
That's exactly right. So it just depends what the person wants. But asking the questions, that's the important part, and it's probably a good time to add a little more color. Every marketing organization out there today can give you product. I mean, it's easy to get product, and now I feel like we're the Pied Pipers. All of a sudden, in the past 12 months, we're seeing more and more marketing companies coming out doing webinars like this. Ladies and gentlemen, we've been doing this for 7 years, pushing these things. We have point-of-sale pieces, presentations, fact finders, and training videos for this market. And we came out of the life business. We do a great job with annuities, but we know life insurance. So we have a case study here with the fixed annuity rescue. Client has a bad annuity they want out of. Bad annuity could be, who knows, it could be very high surrender charges, could be two-tiered, it could be poor rates or caps, or it could be a company that's not keeping the promises that they thought were made to them. In other words, maybe they just, after the first year or two, deep sixed those crediting rates or fixed rates. You may have some policies like that. Well, what we are able to do is we can either annuitize to get the full account value and then pay it into a 7-pay product. Let's take a look at the solution here before I get ahead of myself. Yeah, we can annuitize and make the premium payments to a guaranteed no-lapse UL. So if a person had one of those two-tiered products or a product at the end of 5 years that if you annuitize for 5, you get out without a surrender, perfect for this. We can turn the tax-deferred annuity into a tax-free death benefit, and tax-free is always better than tax-deferred. And we are able to spread out the taxable gain on that annuity over 5, 7, or 10 years, depending upon how we take that money. So there's a lot of great spots. Another example in this fixed annuity rescue would be a 71-year-old male that has a $137,000 account value in the annuity with the 9% surrender charge. Well, they can annuitize for 10 years for full value, let's say. That's going to give us a $13,900 premium for 10 years, which will give us basically $248,000 of guaranteed death benefit with Aviva's Advantage Builder 2. Well, this is my favorite one of my favorite solutions, my favorite situations coming up, and we call it the 5% solution and the lost Social Security income check. Here's the deal. One, the client wants to increase the estate value and minimize taxes. That person had a loss in the market or things just didn't turn out like they thought. They needed the additional death benefit. Again, this person's looking at his timeline. So this guy or this lady, they say, look, I don't want to get rid of that annuity. We have a program called the 5% solution and a video to go along with it. What we do is we just utilize 5% out of the existing annuity. Hopefully it's in an index annuity where maybe we might be getting 5% growth. So we're staying close to the principal. Now, you can take out 10% depending upon the desires of your client. But if nothing else, you take out 5%. Think about the book of business. If you had a $5 million annuity book, we find that 20% of your clients normally want to do this. So that's $1 million. Let's take 5% of the $1 million. That's $50,000. That would mean that you'd have $50,000 of premium each and every year for the next 10 years working your book of business. Let's say at a 90% commission, that's $45,000 with 70% persistency. Going from year 2 through 10, your renewal base in the 11th year will be $35,000 or more. How about a retirement plan for yourself? Well, the client might have an IRA or a non-qualified annuity with a large gain. They're going to use that to beef things up, to have extra death benefit, legacy value. But here's one, the lost Social Security check. When you have a husband and wife, there are 2 Social Security checks. Let's just use an example. We have the man is getting in $2,000, the spouse is bringing in $900. Either one of them dies, and for the sake of simplicity, you're going to lose a smaller check, the $900. Well, what we do is we'll use the 5% solution or more if we have to, and we will buy a life insurance policy where the death benefit, when annuitized, will equal the Social Security check. So the death benefit's not going to be a 25 or a 35 or a 55 or 90. It may be a $42,354 death benefit because that is exactly how much in today's dollars we need to have a Social Security check of $905.45. People need both Social Security checks. They still can live in the same house with the same payment. They usually have one car. It's not going to cut down their clothing that much, and their property taxes, their gas bills, everything else will stay the same. And I would challenge you to ask them where they think income taxes are going. So with this solution, we draw the 5% from the account annually to pay for the new life premium that we're just talking about. We keep the current IRA or non-qualified annuity active. We're just pulling money out of there. And we have a life policy to pay for taxes owed on those annuities, as well as the other example on the Social Security. Well, here's one, a 68-year-old female, preferred non-smoker, a $280,000 IRA. What we're going to do is we're going to withdraw $14,000 annually. That's that 5% withdrawal for 7 years. That gives us a death benefit of $145,000 and some change. We're going to use a Sagicor 7-pay whole life, which is simplified issue, which is then going to get us a death benefit of $425,000 and a first-year commission of $5,375. Pretty darn strong.
Let's take a look at about there is the $425 in total estate value with the IRA.
Yes.
Plus death benefit from the Sagicor.
Thank you very much. All right, as we're moving along here, let's look at a long-term care alternative as we're getting down to the last 5, 6, 7 minutes here. We have a 72-year-old widow who wants long-term care protection, but doesn't want to purchase traditional long-term care insurance. Decent health, high blood pressure, has $150,000 set aside for children and grandchildren in cash and investments. That's the situation. Let's take a look at what the solution would be. We're going to move that $150,000 into the Sagicor fixed index single premium whole life contract with the chronic illness rider. The guaranteed face amount, the death benefit, is $255,000. So through, again, this telephone interview, basically through the miracle of paper and ink, we are turning $150,000 into $255,000. If the person could not do two of the activities of daily living, and again, as I said before, they don't have to be institutionalized. They don't have to be in a home. They don't have to recertify. They will receive $6,970 a month. $6,970 a month. Well, I would say, as Nick did early on today, and as a speaker said this morning, the best bet's buy long-term care insurance. But we have companies dropping out of the market. We have companies dropping out of the hybrid products. Genworth, the most recent, with their great annuity. And rates going up on long-term care. And some people just don't have the money to pay the premium. But they don't want to be a burden to their family or their friends. Someone's going to pay for long-term care if, in fact, they have a problem. This allows them to have triple duty dollars. Dollars for growth in the cash value that they could have access to. They could even turn some of those dollars into income. But as Nick is helping me out here, let's take a look at the recap of all the things that we have. Again, we don't have a use it or lose it scenario with this long-term care insurance alternative. And again, we don't have to take special LTC CE. Okay, recapping what we have here with capital transfer. One, we're going to increase total estate value in basically every situation. Not basically, in every situation. We're going to provide an income tax-free death benefit. We're going to avoid that annuity tax time bomb. And remember, on that annuity tax time bomb, not only if mom and dad leave those dollars to the kids, not only will they pay tax on the gain, it will also be included in their adjustable gross income, which could push them into a higher tax bracket. We're going to be able to recover some market losses for the heirs. The guy had $1 million in the portfolio's down to $850. Let's buy a couple $100,000 of death benefit and get that thing back to where it was and ahead. It's a good place to rescue annuities that are operating poorly. And who knows what is the definition of operating poorly? If your client doesn't feel good about it, it's poorly. They feel poorly about it. And I don't want people, I would never suggest that people go out and churn and burn and rock and roll. But when a better job can be done for your client, you need to do it. And especially with companies that have taken the risk of putting the annuity on the marketplace in a couple of years, deep sixing the rates, hoping that no one notices. You have to remember, it's your client. It's your client that took you to the dance that gives you the referred leads. And we're going to provide long-term care insurance alternative protection. Just a minute ago, I mentioned getting referred leads. Ladies and gentlemen, getting referred leads in this market is a heck of a lot easier. The two hottest concepts today, and they go hand in hand, are the personal pension plan, income planning, along with capital transfer. You know, people, as they get older, they notice that their timeline starts to shrink. And again, they know that they are going to die. And they think about it. I don't care if you're 60, 70, 80, or 90 years old. You start thinking about all the things maybe that you thought about doing, you didn't do, and you don't want to be forgotten. And that's why we have these tremendous monuments all around the world, all around America, from the World War II to the Vietnam memorials, and it's about time they did those things. People want to be remembered, and legacy transfer, capital transfer, leaving more money to friends, to universities, to religious organizations, to charities, to challenged children, to gifted children, to their own children, to their grandkids, leaving up a legacy that can be passed for years and years. It's the miracle of paper and ink, the miracle of life insurance that makes this happen. We have the finest product in the market today with a life insurance contract. The annuity is a tremendous thing, but annuity is not always the best place to leave your money. So in closing, before I turn it over to Nick, we're very excited and so happy about the life insurance industry today that many of you have seen in the Ohlson report today. We're very proud to have Gary Ryan, JD, LLM, CLU, CHFC, as our life insurance and advanced marketing specialist. Many of you know Gary. Gary was president of Indianapolis Life Annuity, chief marketing officer with Indianapolis Life, senior VP of marketing with Viva, as well as vice president, head of the advanced underwriting department of American General. He also is a very good life insurance agent in his own right. He has joined us, and he's standing by ready to work with you on cases, especially cases where you need some additional help and those universal life audits where we can find out if the companies truly kept the promises that they were making to your clients. And also, we have a lot of stuff going on in the world today, and my heart goes out, as I know yours does as well, to what they're going through in Japan. But on top of that, too, as I said, we had the Nikkei was down 13% when they came to work this morning. It's affecting our market. Many things can turn the market on a dime. I believe in the equity markets. I believe in growth. But there comes a time when people want to park some of their money in safe money places. And at the Ohlson Group, we have that in spades. So again, come on, let's get the $2,000 bonus. We've got a couple weeks to do that. $500,000 you'll be eating Lucky Charms in Ireland. And we've got additional bonuses going on with index annuities. Call us. But I can't tell you how much we appreciate the business and appreciate your support. And I hope that you found this to be of interest. You'll see our numbers on there, 877-844-0900. And Nick, I'm sorry to take over here. You were just sort of echoing, but I'll turn it over to you now to say goodbye to everyone.
Yeah, well, I'm still echoing, I guess, but thanks, everybody, for tuning in. Anything at all we can help out with, just give us a call here. We're ready to put these cases together for you, and just ask to have the chance to earn your business, guys. Thank you very much.
Goodbye.